That's if you make mistakes in business, plenty of people make mistakes. You pay for them.
For years, the real estate market has been an oasis for investors seeking shelter from the stormy seas of uncertainty. But now, Warren Buffett, a billionaire and the undisputed guru of savvy investment moves, predicts a brewing storm in the real estate market. This video will dissect Buffett's warning for homeowners, investors, and the real estate troops on the front line, leaving you with a fresh perspective. 1. Mortgage interest rates. After a period of strong home sales and rapidly increasing home prices, the housing market has significantly slowed down. This is mainly due to a surge in mortgage interest rates. The rate rise began in March 2022 when the 30-year fixed rate exceeded 4%. Throughout 2023, the 30-year fixed rate has remained around the mid-6 range. Because interest rates are now more than double what they were in 2020 and 2021, and there is a sharp decrease in buyer demand, home prices have also started to decrease. This raises the question, is the housing market on the brink of a crash after 2 years of strong sales? Well, lenders are diving deep into the tumultuous world of the banking industry, trying to figure out the long-term consequences of recent failures by Silicon Valley Bank, Signature Bank, and First Republic Bank. Their attention has shifted to potential trouble spots and the growing credit risks lurking within commercial real estate loan portfolios.
This is going to be a crisis point that the government is going to have to step in, that something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points.
Why? Well, there are a few factors at play here. First, there's an undeniable unease surrounding lending, which only amplifies existing worries. On top of that, the commercial real estate (CRE) sector was already under pressure due to pandemic-induced changes like the rise of remote and hybrid work, leaving countless commercial spaces vacant. And if that wasn't enough, the Federal Reserve decided to play the spoiler by jacking up interest rates a staggering 4.75% over the past year. Now, refinancing commercial property loans has become a real pain, forcing borrowers to take on more debt or develop substantial capital to meet the new loan-to-value ratios. Back then, low interest rates and favorable market trends created the perfect breeding ground for CRE lending, especially among regional and community banks. But here's where things get interesting. Warren Buffett thinks there's a growing concern about potential cracks in CRE portfolios' credit foundations. According to the Mortgage Bankers Association, a whopping $1.4 trillion in CRE loans is set to mature by the end of this year and 2024. Property values are tumbling and more borrowers default as interest rates rise and the economy slows down. This is causing a ripple effect of uncertainty. 2. Impacts of real estate crash. The impacts of this stress in the commercial real estate realm could be widespread. A downturn in this sector can potentially tighten credit availability, making it harder for businesses to get the necessary funds.
Everybody goes in the real estate business is told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages and they're going to walk away and the bank's going to get stuck with losses, and maybe they'll hold the property a long time and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it. But that money is sterile for quite a while, and that's part of banking.
The banking industry currently holds a significant 54% stake in the colossal $5.7 trillion CRE market, while smaller lenders carry a whopping 70% of CRE loans. To put it into perspective, data from TREP indicates that a jaw-dropping $1.4 trillion in U.S. CRE loans will mature by 2027, with a staggering $270 billion coming due this very year. Changes in interest rates have a direct impact on buyer behavior and market dynamics. A decrease in interest rates incentivizes homebuyers as it reduces the cost of borrowing and lowers monthly mortgage payments. Higher interest rates increase borrowing costs, reducing the net income generated by rental properties or affecting the profitability of property sales. Another thing is the DSCR, or Debt Service Coverage Ratio, and property lending. The Debt Service Coverage Ratio, DSCR, plays a vital role in property lending decisions as it measures a borrower's ability to make debt payments. It is calculated by dividing a property's net operating income, NOI, by its debt obligations. The DSCR Loan Interest Rates Index currently stands at 8.09% for competitive terms. This index is influenced by the 5-year U.S. Treasury, which is currently at 4.586%. In the past week, the 5-year U.S. Treasury has decreased by 0.214%, causing a similar decrease in DSCR loan interest rates. Well, DSCR loan interest rates will stay high until the Federal Reserve finds a way to manage inflation and stops increasing the Fed funds rate. 3. Risk for commercial property owners. In the world of commercial property ownership, it's not all roses and sunshine. Unlike residential mortgages with predictable fixed rates, commercial property values are tightly tied to market conditions. So when the market booms, property values soar, dragging those dreaded interest rates up alongside them during the reset. Conversely, during economic downturns, property values can plummet.
The big news is that with the enormous growth in private equity, the enormous explosion in real estate prices as well, you've had both in the corporate world and in the real estate world an abundance of balance sheets that really weren't created for higher interest rates. People built things with higher and higher multiples of EBITDA in terms of debt. Interest coverage was quite small, and instead of being able to fully grow into those balance sheets, there was a 2-year interruption, often in revenues with COVID. Right. So as those balance sheets start to mature, I think a lot of private equity sponsors have some hard decisions to make as to how to reconfigure those balance sheets.
But those interest rates might stubbornly stay high, leaving property owners teetering on the brink of financial disaster. Office building owners face significant financial troubles, primarily due to non-recourse loans. You see, non-recourse loans are loans where the borrower is not personally liable for repayment. Here's an example of a non-recourse loan. Peter, a successful entrepreneur, wants to purchase a commercial property worth $1 million and seeks financing from a lender. The lender agrees to provide a non-recourse loan, where the property is collateral. In this scenario, if Peter defaults on the loan payments, the lender is limited to foreclosing on the commercial property, the specific collateral. In simple terms, the lender cannot pursue legal action or go after Peter's assets to try and collect the remaining loan balance. These loans have become popular in the real estate market because they limit the lender's ability to go after the borrower's assets in case of default. However, they also come with risks and challenges. These loans have shorter terms than traditional ones, usually around 5 to 10 years. When the loan term ends, owners must repay the entire balance or refinance the loan. However, refinancing becomes exceptionally challenging if the property's value has dropped below its purchase price, often during an economic downturn or when demand for office space declines. Lenders usually require the property's value to be equal to or higher than the loan balance. This leaves owners in a tough spot. They might have to sell the property at a loss or default on the loan if refinancing isn't possible. In the case of a non-recourse loan, the lender's recourse is limited to the property itself. So, if the property's value has decreased, the lender can foreclose on it and sell it to recover their investment, leaving the owner facing financial losses without personal liability. With the current state of the market, office buildings are seeing less demand and lower values. and owners are at a higher risk of facing foreclosure and financial losses.
It shows you how dependent on low interest rates the sponsors were, the investors were, and the owner of these buildings were. So it's an issue, but I think people need to recognize and take a step back. Commercial real estate is a large industry. I mean, this is an industry that involves industrial storage buildings, it involves multifamily apartments, it involves hospitality, hotels.
I think people picture only office buildings now.
It's not only office buildings. There's office buildings are where the pain is. Retail has seen some pain with e-commerce growing, but there's parts of retail that are becoming, more attractive. But yes, offices are in trouble. There's not much we can do about it.
In fact, by 2030, the demand for office space is projected to decrease by approximately 13%, indicating a potential decline in the need for physical office locations. This trend could have serious consequences both for individual owners and the economy as a whole. The commercial real estate transaction market has slowed considerably in the past year because of the uncertain nature of interest rates, inflation, and economic performance. Consequently, real estate owners and investors are closely monitoring interest rates to understand how they might impact the long-term profitability of their commercial real estate investments. This uncertainty has made it challenging for new real estate developers to secure financing that aligns with their budget, as the higher cost of debt has put additional pressure on them. 4. Impact on small banks and economic growth. Small banks have substantially greater exposure to U.S. commercial real estate (CRE) loans than larger banks, with an exposure of 4.4 times higher. Among these small banks, CRE loans constitute 28.7% of their total assets, while large banks have only 6.5% exposure. Additionally, there is cause for concern as a notable portion of these loans will require refinancing shortly, which could create challenges for borrowers in a rising interest rate environment. When the commercial real estate market becomes uncertain and unpredictable, it can cause small banks to lose money. These banks have invested in commercial real estate assets, and if the market declines, the value of these investments can go down. This means that the banks might face financial problems or even go out of business. This loss of money for the banks affects small businesses too. Small businesses rely on these banks to get loans and credit to run their businesses and make investments. However, when banks face financial difficulties, they become more cautious about giving out loans. This means that small companies might not be able to get the money they need to grow and expand. Without access to credit, small businesses can't create jobs or contribute to economic growth in their communities. Moreover, small banks often have close relationships with local businesses. They understand the unique needs of small businesses and are more willing to lend to them. However, when banks deal with financial losses, they focus away from small businesses and on fixing their problems. This means that small businesses might not get the support and attention they need from the banks to succeed.
1.5 trillion of maturities on these commercial real estate loans due by the end of 2025. So basically, picture like 500 billion a year is going to need to be paid off, over the next 3 years. And ultimately, the sponsors are going to need to find ways to get equity or debt into their capital stacks to pay off these loans. And what we can count on is, as the banks have kind of pulled back recently with the regional banking crisis, there likely will be more private equity partners entering into the capital stacks of these commercial real estate loans to help these maturities and to get this wall, paid off. But not everyone's going to get that money. These are tough negotiations.
5. Tips to prepare for a real estate bubble in 2023. While it is difficult to predict precisely when a bubble will burst, real estate investors and homeowners need to be prepared. One crucial step to mitigate the impacts of a real estate bubble is to diversify your investment portfolio. Imagine having $100,000. Instead of putting it in one investment, allocate $40,000 to stocks, $30,000 to bonds, $20,000 to a broad market index fund, and $10,000 to commodities. If one asset class underperforms or faces challenges, the others may potentially compensate for the loss. This is what diversification is. 2. Buy within your means. When preparing for a real estate bubble, it is crucial to avoid overextending yourself financially. Purchase properties that you can comfortably afford, considering the potential collapse of housing prices or rising interest rates. For instance, if you are considering buying a home, ensure the monthly mortgage payments are within your budget. It is essential to consider the possibility of a decline in property values and not rely solely on the property's appreciation potential. By adhering to this principle, you can safeguard yourself from potential financial distress if the housing market experiences a downturn. 3. Consider a fixed-rate mortgage. Choosing a fixed-rate mortgage can provide stability during times of economic uncertainty. With a fixed-rate mortgage, your interest rate remains constant over the loan term, shielding you from future interest rate hikes and enabling monthly payments regardless of market fluctuations. 4. Seek more knowledge. While predicting a bubble's precise timing is challenging, staying informed about market trends, economic indicators, and expert opinions can provide valuable insights. For instance, monitoring key indicators such as housing affordability supply and demand dynamics can help you gauge whether the market is showing signs of becoming overheated. By staying abreast of such information, you can make informed decisions about buying, selling, or holding real estate investments and reach your goal of becoming a future billionaire. 5. Consult with real estate professionals. When preparing for a real estate bubble, seeking guidance from real estate professionals is invaluable. Experienced real estate agents, financial advisors, and market analysts can offer insights and guidance based on their industry expertise and market knowledge. These professional and experienced real estate experts can help you analyze current market conditions, assess property values, and identify potential risks. Buffett's success serves as a reminder of the crucial importance of exercising discernment and making careful investment decisions. Pay attention to your investments and adopt a mindset of not only prioritizing making money, but also avoiding losses, as Buffett famously advised. By focusing on both aspects, you can strive for long-term financial gain and safeguard your investments. So, what do you think about the real estate bubble? Will it burst? Share your views in the comments section. If you garnered something new today, share this video, give it a thumbs up, and subscribe to this channel to expand your horizons. And if you're ready to open the doors of your revolution, watch the next video.